Okay, we are back and continuing our conversation today, which is the last class of Principles of Accounting 1 here at UDC in the spring 2023 semester. The semester officially ends this Saturday. By this Saturday night, I need you to complete your work for chapters 15 and 16. The majority of you in the class have already done that. So thank you so much for working ahead. I really appreciate that, and hopefully you see that your efforts are paying off. You're all doing very well in the course so far. So thank you, thank you, thank you, thank you. I can't thank you enough. Okay, let's go ahead and talk about statement of cash flows, then we'll have some concluding thoughts. Statement of cash flows. There are three categories on the statement of cash flows. We have operating activities, investing activities, and financing activities. These three categories on the statement of cash flows shows us how the company is using cash when it comes into the business and out of the business. That's what the statement of cash flows is. It shows cash coming in and cash going out of the business. So I call it cash flows, right? Why do we have a statement of cash flows? It shows how the company is receiving cash. Is it from cash sales that we made to customers? Is it from a loan that we took out? Is it from a sale of property, plant, and equipment? All of those things are cash coming into the business, but it's for different reasons. When I make a sale to a customer, I sold them some inventory, or I provided a good or a service, and the customer paid me in cash. That's cash coming into the business for operating activities. Operating activities, that's the day-to-day operations of the business. Those are operating activities. Operating activities represents the day-to-day operations of the business. Okay, it's operating activities on the statement of cash flows. When I sell something to a customer, that's cash coming into the business, and that's an operating activity. Because selling stuff is what I do. That's how I operate, you see? Other reasons why cash might come into the business. The business sold property, plant, and equipment. That's not operating. The business is not in business to sell property, plant, and equipment. Our business is to make products and sell them to the customers, not to sell our property, plant, and equipment. But when a company sells their property, plant, and equipment, there's cash coming in from that sale. That is actually from investing activities. So cash coming in from investing activities is when I sold property, plant, and equipment. Or, that's it. When I sold property, plant, and equipment. That's cash coming in for investing activities. Another reason why cash might come into the business is we took out a loan, or we issued shares of stock. We issued a bond. When I issue a bond, or I issue shares of stock, or I take out a loan, those are what we call financing activities. I'm financing the business. When I finance the business, I got cash coming in from a bank loan. I got potential cash coming in from issuing shares of stock or issuing a bond or CD, certificate of deposit. Those would be reasons why cash comes into the business for financing reasons. Let's talk about cash going out of the business. The reason why cash goes out of the business for three reasons: operating activities, and investing activities and financing activities. For operating activities, the reason why cash goes out of the business is because we're paying our bills. I'm paying my suppliers. I'm paying my utility bills. I'm paying my rent. I'm paying my employees. These are operating activities, day-to-day operations of the business. When cash goes out of the business for operating activities, it's because I'm paying my bills, I'm paying my employees, I'm paying my rent, I'm paying, things for daily operations. So that's cash going out of the business for operating activities. For investing activities, it's when I purchase property, plant, or equipment. When I purchase property, plant, or equipment, I'm investing in the company by purchasing property, plant, and equipment. The cash is going out of the business because I'm purchasing the property, plant, and equipment. You see? The third reason why cash leaves the business is for financing. I'm repaying my loans. I'm paying a dividend to my investors. I'm repurchasing stock. I am repaying a bond at maturity. These are finance reasons why cash goes out of the business. You see? So, remember, cash comes into the business from sales to our customers for operating activities. Sold property, plant, and equipment for investing activities, or we issued stocks, bonds, or took out a loan for financing activities. Cash goes out of the business when we pay our bills or other operation expenses, operating activities, when we are purchasing property, plant, and equipment for investing activities, or for financing activities, it's when I'm paying a loan, issuing a dividend, repurchasing stock, etc. It's the concept of the statement of cash flows. Why is the statement of cash flows important to understand? It tells me, the company manager or owner, how much cash I have coming in and how much cash I have going out. It helps me to more effectively manage my business because I can plan the day-to-day operations. I know when I have cash coming in based off of my accounts receivable. Eventually, the customer is going to pay us back on the accounts receivable. I can plan when I'm going to receive that cash. I can plan when I'm going to take out a loan. I can plan when I'm going to sell property, plant, and equipment. So I can plan for the cash coming into the business. The same can be said for the cash going out of the business. I know when my bills are due. I know when I expect to sell property, plant, and equipment, or I know when I have to repay a loan. So the statement of cash flows helps managers to plan for the day-to-day operations of the business. It helps with those unexpected things as well. It also helps us to make better long-term investment decisions. Cash is highly liquid. What that means is when I have cash, I can do anything with it. Okay, it's highly liquid. Cash equivalents are things that I can quickly convert into cash. Say that again. Cash equivalents is when I can quickly convert something into cash. Example of this would be certificates of deposit, bond notes, Yeah, that's it. Those things I can quickly, very easily convert into cash. Yeah. That's what we call cash equivalents. So to recap the three categories on the statement of cash flows, we have operating activities, that's the day-to-day operations of the business. Investing activities, that's property, plant, and equipment. Financing activities, those are loans, also known as notes, certificates of deposit, stocks, bonds, financing. Yeah. Cash comes into the customer from operating activities. We sold stuff to customers. We received a dividend. We're collecting on our accounts receivable. We received interest revenue. Those are all reasons why cash comes into the business for operating activities, day-to-day operations of the business. Cash goes out of the business for all of the business expenses, operating expenses, taxes, interest we got to pay. Got to pay our suppliers. Got to pay our wages. Operating activities. Investing activities. Purchase or sale of property, plant, and equipment. Very straightforward. Or other long-term assets. Some short-term assets as well, depending on what it's for. Financing activities, again, these are things like the loans, stocks, and bonds. Other financing activities might include things for what we call non-cash investing. Non-cash investing is typically when I exchange something for another. Okay. Retirement of debt by issuing equity stock. In other words, I'm exchanging a loan for stock. Conversion of preferred stock to common stock. That's just a simple switch, the type of stock. Lease of assets for a capital lease transaction. Purchase of long-term assets by issuing a note or a bond. All I'm doing is I'm switching for a note or bond. Per exchange of non-cash assets for other non-cash assets. The purchase of non-cash assets for issuing equity or debt. Like when you see non-cash, all that simply means is we're exchanging one thing for another. Now let me show you what the statement of cash flows looks like. There's a couple ways to do this. This is what you see right here in front of you is called the direct method. The direct method. At the very top, we see operating activities. In the middle is investing, and at the bottom is financing. It always looks like this. This is a standard format. Operating is always at the top, investing is always in the middle, financing is always at the bottom. We take cash coming in minus the cash going out for each category. So cash coming in from operating activities minus cash going out from operating activities equals the net cash flow for operating activities. Cash coming in minus cash going out equals the net. Cash coming in minus cash going out equals the net. Do that for each activity. Then we add up all of our nets to get the net increase or decrease depending on what happened, right? We take cash at the beginning of the accounting period to give us the cash equivalent for the current period. Very straightforward equation. Five steps to completing the statement of cash flows. First, we figure out the increase or decrease in cash. Then we compute the net cash from operating activities. Then we compute the net cash from investing and then financing. And then we add it all together. Another reason why we go through this process is because we need to verify that the cash in our bank account matches the cash in our account, matches the cash in our statement of cash flows balance. And the balances need to be there. They need to be equal. And so we go through the reconciling process. Here's a very straightforward way to analyze non-cash accounts. Take cash equals liabilities plus equity minus non-cash assets. All we're doing is we're solving for cash, right? Remember, the accounting equation is assets equals liabilities plus equity. If I need to solve for X, all I do is I put everything else on the other side of the equal sign. Straightforward. That's a way we can find the balance of a single account without having to know what that balance is. We need a couple pieces of information to create a statement of cash flows. We need the balance sheet, we need the income statement, and we need additional information. There are two methods for calculating the statement of cash flows. First is called the direct method, and the second is called the indirect method. The direct method is where we take the net cash for operating activities. The net cash for operating activities. Very simply put, that's the cash coming in from our customers and the cash going out for our operating expenses. Coming in from our customers minus all of our expenses that we paid during the accounting period equals our net cash for operating activities. That's the direct method. It's the easiest method of the two. What if we don't have that information available? We can use what's called the indirect method. The indirect method, instead of taking the net cash for operating activities, we take the net income amount. And then we subtract out all of our receivables, our payables. We add in a couple of odd expenses like depreciation, loss or a gain. Ultimately arrive at the net cash flow provided by operating activities. See, it's the same amount. It's just a different way of getting to that amount. The indirect method, we're not taking into consideration the actual cash flows. That's why it's indirect. Indirect method, it's complex. Okay, it's not easy to understand. That's why we have so many slides covering the indirect method. So we take, on the income statement, we take the net income amount. On the balance sheet, we look at the changes in the balances. These pieces of information, shown here on the additional information area, help us to put together the indirect method. We see the changes, we see the net income, and I start the calculation process. Take the net income amount, then I look at depreciation expense, loss or a gain. Those are from the income statement. And then I look at all the changes in assets and liabilities. This helps me to derive the net cash flow amount for operating activities. Very complex. But again, the reason why we do the indirect method sometimes is we don't always have the information available to us to show the cash coming in and out of the business for operating activities. So that's the concept behind that. The adjustments come from the increase or decrease in assets and liabilities. That helps us to ultimately derive the indirect method. And so all this is showing you how we derive that indirect method amount. As long as you walk through the steps, you'll be able to figure it out very easily. But it's just a more complex way of going about it. And this is just the summary of showing us the indirect method. For investing and financing activities, it's very straightforward. The investing activities, as we know, with purchase or sale of property, plant, and equipment, and the financing activities comes from things like notes, bonds, stocks, etc. But there's a three-step process that we can go for each one. For investing activities, identify the related accounts, use the T accounts, and report their cash flows. It's a very straightforward process. We can look at the adjusting entries, look at the T accounts, then we can identify the changes. It's kind of a long way of going about that. For the financing activities, same concept. Identify the changes, look at the T accounts, report the cash flows. Here are your changes, the adjustments, and then your T accounts. This is more like a visual aspect of things to help you to better understand the concept. Another example of that. And then one of the last things we do is we validate. We verify that our cash balances are accurate. How do we do that? We compare the statement of cash flows to our bank account or bank statement. We do that through the T account process. Then, of course, a couple of ratios that we can run to look at our cash uses and how well we're using those. Look at the cash flow to make business decisions. Creditors look at our cash flow to make decisions whether to lend to us or not. Investors look at our cash flow to make investment decisions. These are reasons why cash flows are so important. And one of those ratios is called the cash flow on total assets. We take our operating cash flows divided by our average total assets. When you see operating cash flows, we're looking at the net cash flow divided by average total assets. That's beginning balance plus end balance divided by 2. And just to show you how some accountants would justify that the statement of cash flows is correct is through an Excel worksheet. Yeah, it helps to organize the work. The direct method is very straightforward. The indirect method is what's probably the most complicated for the operating activities. Okay, are there any questions, comments, concerns about the statement of cash flows? We're all good? Statement of cash flows, any questions, statement of cash flows? All okay?
No, I don't have any questions for Feston.
Okay, awesome. Great news is we got about 10 minutes. So what that means is we have a few minutes to look at the final exam. So let me stop this recording. I'll start a third one for the final exam review. So stand by. Just a sec. Let me figure out how to do that.